Welcome back again to Boutiques on Wednesdays. For our session today, the BCI team assembled a fantastic panel of true experts coming to or looking at the property sector or REITs locally as well as globally. Is this the time to reconsider allocating to an asset class that's been under a lot of pressure for various reasons for a while now? Or can higher rates for longer spoil the party? Who knows? It is my absolute pleasure to welcome our moderator for the session today, Rafiq Taylor, Head of Implemented Consulting and Portfolio Manager at Sanlam Multi Managers International. For our audience out there, for those of you who don't know them, and I doubt that there's any, but SMI is probably one of the largest DFMs in South Africa, assisting numerous intermediaries like yourself with innovative, customized solutions to meet the very specific needs of your clients. And they do this by a very well articulated and disciplined investment process. The head of their team, as I mentioned, is Rafiq. Rafiq comes with a wealth of experience when it comes to portfolio construction, asset allocation, and very importantly, manager selection and how they blend managers in the portfolio. So also a true expert to lead our panel this morning. Good morning, Rafiq. Really great to have you join us, and thank you for your time. How are you doing today?
Eugene, good morning. Thanks for that fantastic introduction. I'm doing incredibly well and excited to talk about an asset class that, to be honest, when doing a little bit of homework, there's not much people talking about property in any quantity relative to what's out there in the market. So really excited to talk about an asset class that I think is probably down in the dumps, but is looking super attractive at the moment.
No, exactly. And I think that's going to make this discussion very interesting indeed. And I'm looking forward to see how you're going to lead this. If you want to introduce your panel, you're more than welcome, Rafiq.
Thank you very much. Yeah, good morning, gentlemen. I think from my side, a warm welcome to this webinar, and to all the viewers and the participants that came in. Thank you so much for taking the time out. I'm going to introduce the panel from Sesfikile Capital. We've got Kundai Manzara, Portfolio Manager and Director of that asset manager. We've got Mike Flax, who comes from Visio, Portfolio Manager and Head of Property. And last but certainly not least, Greg Rollins from Reitway Global, who heads up that business as well. Gentlemen, thank you and good morning.
Morning.
Morning, everyone.
So let's kick off. I think what we'll do is we'll talk about property within the local context and then the offshore context, and kind of starting with SA property, but I guess kind of universally for the sector on a global basis, you know, and maybe going straight into the local listed property market. You know, the SAPI, which is the index that kind of tracks the companies, listed property companies in South Africa, has kind of been languishing for the last couple of years now, and since 2017 when it hit its peaks, you know, we've seen a very, very severe drawdown and, you know, kind of lackluster performance and price levels that we've seen back in 2008. I mean, is there any hope for the asset class in the near term, I suppose, given the tough environment that we are moving into or have been in now for quite some time, if you want to look at it from that perspective? I think, Mike, if you want to go, but I'm happy for the rest of the panel to contribute to this question, which I think is probably at top of mind for all of the participants and the audience watching this webinar.
Okay, thanks, Rafiq. I mean, I think the sector right at the moment is pretty well positioned now that the operating fundamentals have now stabilized. You know, it looks like occupancies are pretty stable right now, that the negative reversions, you know, that were really hitting the companies have contracted, and maybe in many cases are turning positive now, and escalations have stabilized. But the reality is that property will start performing very well as soon as interest rates start moving downwards. And then As we all know, there'll be a sudden and frantic search for yield amongst investors, and that's going to drive pricing corrections. On top of that, right now, building cost inflation is battering building costs. The cost of replacing property is going through the roof. And that alone, coupled with the impact on rentals that increasing cost of property drives, we'll see bottom line growth. So I think even despite perhaps higher for longer borrowing costs, dividends will still show growth given these kind of fundamentals in place. But I suppose the bottom line is that the real catalyst for performance requires the economy to grow at reasonable levels.
100%. Greg, do you want to contribute to that?
Yeah, Rafiq, we're more clinical about our view on South Africa because as a global property fund manager, everything that we do must deliver a relative international performance. And the fundamentals are, our view is still very weak for South African property. And it's not just South African property. For instance, we exited Hong Kong about 2 months ago, and we're probably at our lowest level ever in the UK. So we don't see for the near future an inclusion of South African listed property in our global property portfolios because of the fundamentals are still very negative, and we can get better visibility and growth elsewhere.
Yeah, if I could, thank you, Rafiq. But maybe kind of coming back to South Africa, I think, there's always a lot of focus on, this question of when will the economy come back roaring again? When are we going to see 5% GDP growth, right? And I think to Mike's point, what's important, all of us want GDP to grow, but I think on our side as Circular Capital, we're not making any big kind of bullish assumptions on the economy, but actually rather just looking at the property fundamentals. And to support Mike's points, if you look at the South African listed property sector, on a see-through basis, about 63% of that is retail, with about 15% office, 15% industrial. Now, if you look at that and you say, what's actually happening in retail? Very little new supply has come in the form of large format shopping centers. However, what we've seen is that a lot of domestic retailers have almost cut or shelved their international expansion plans and have refocused on growing in South Africa. And what we've seen as a result is a massive drop in vacancies to the levels of 3 to 4% across many of the REITs. In industrial, vacancies for kind of modern logistics warehouses are between 2 and 4%. The office sector, which is obviously everyone's whipping boy, locally and globally. In South Africa, even in that segment, the prime grade office has seen vacancies compressed to about 9.2. So contrast that to the US office sector, which is at about 21% vacancy. South Africa is around 16% on average and 9.2 for P grade. Now, putting those things together, I totally support Mike's point that the top line rental growth number is actually starting to come back and is in the region of about 4 to 5% on a NOI basis. Now, and that starts to encourage us because it's kind of approaching where inflation is. And then the kind of last point when you're looking at the South Africa sector is that all of this doesn't matter if the valuation argument doesn't support it. So as fund managers, our job is to not only point out good fundamentals, but to look at good fundamentals in context of valuations, or bad fundamentals in context of valuations. Now, to put some numbers to that, our sector is trading at about a 37% discount to NAV, 11% distributable income forward yield, and the growth is in the region of, let's say, 2% over the next few years per annum. Now, putting those things together, we think there's deep value in the listed property sector. And again, supporting Mike's point is to say, what is the catalyst? So value is there, but what actually makes people excited about that value? And I think as we are approaching the peak in global interest rates, I think South African interest rates have probably peaked. US is next, we think. And once that happens, we think that will be the time to really get exposure to the sector. But you don't want to do that after power has told you that, it's all over for hiking rates. You actually want to start positioning prior to that. And that's where the opportunity is for allocators and us as fund managers.
Thank you so much. I mean, there's definitely some sort of this, I would say, difference of opinion around like the prospects for SA property. But I guess coming to the next theme that I guess we've been seeing also within local listed property is that, and it's been a pervasive for some time, is that the universe that that you all need to select from is quite a limited universe, and that the concentration is actually quite stark when it comes to property companies' exposure within the index. I guess the question from my side, and Kunda, maybe you can start with us on this one, is, this opportunity set, is it actually a viable opportunity set for investors? And so I guess the question is, how do you think investors should be thinking about using local listed property within the solutions, and how do you guys think about property, SA property as an asset class, given this limited universe?
Yeah, thanks, Rafiq. I think to that point, some of our clients have asked a similar question. But if you actually look at how many investable listed property companies there are on our sector on the JSE, there are about 24 different opportunities. However, to your point, there is quite a bit of concentration at the top, where you've got a few, more liquid, larger cap stocks that almost dominate the index. But what we've started to see, maybe to come to the point of, is it a viable investable opportunity set, is that we are starting to see much more bifurcation between the different opportunities. So Equitas, pure play industrial, Spear REIT, although a smaller company, pure play Western Cape. Growthpoint is usually seen as kind of like the bellwether for the sector, and Redefined because they're big diversified names. But I would say that the actual real opportunities is a level before that, where there are companies that they're well run by well-aligned teams or entrepreneurs that are running these businesses, and you've got a higher degree of specialization, which I think to Greg would point out that you see all over the global investment universe. And we're moving more to differentiation and specialization. And it's actually popping out in the actual operating performance. So even if the economy is flat, the differences in operating metrics for a Spear or a Vukile or an Equitas or a Sirius, which has German and UK assets, is very different. And that's what creates the opportunity set for investors. And I think, we sometimes have short memories, and there was a time, 2007, 8, 9, where we had an effective listing boom in the listed property sector. And over the last few years, we've seen a bit of a contraction as people have seen value, like Liberty 2 Degrees going private and all of that stuff. But these things come and go. So, we think that in time, should the interest rate cycle starts to point down and companies start trading again close to NAV, or in some cases at a premium to NAV, you will see another listing boom again. So over time, these things, expand and contract. But today, it's not like you have nothing to choose from. You've got 24, different companies that you can buy, and they all behave very different, which is an important thing.
I think, just adding on to that, if one looks like at the property index and taking into account the comment that you made, Kundai, but maybe just going to Mike on that, and maybe just talking about your view. Your business actually has a myriad of solution sets across, equity and some specialist asset class funds, all the way to some multi-asset solutions. How, given what Kunda has kind of sketched around the opportunity set, do you guys think about that within the context of, allocations to property, be it offshore or local listed property within, say, a multi-asset framework, which I would say that the majority of our viewers that are on this webinar are trying to think about when they are looking at adding property to a portfolio.
Yeah, an interesting one. I mean, just looking at the domestic, our domestic REITs, on a look-through basis, this in the SAPI, South Africa is only 43% actually. South African properties in that total index, only 43%. In fact, Europe's a lot bigger. Central and Eastern Europe mainly, and some Western Europe is probably around 60% of the SAPI index, and the ORPI as well. So that Euro exposure is very important and big, and some of those Euro destinations, Central and Eastern Europe destinations, are showing fantastic fundamentals. I mean, they've controlled wage growth, they've controlled inflation. Poland and Romania have done extremely well. They've got unemployment at around 5%, very, very healthy, and that's where a lot of our domestic funds, in fact, have their assets sitting, and there's no load shedding in these destinations. And I mean, there's a lot of advantages for the 24 opportunities that we have. And property, listen, as far as the multi-asset strategy is concerned, it's very important. I mean, it's an important component. It's underpinned with high dividend yields. It helps to de-risk the return profiles. And I think it's just an attractive feature, in these current volatile markets. So we believe that, real estate should be at least 5% of any multi-asset portfolio. In fact, in the US, at times, in fact, perhaps if you look over the last 20, 30 years, it's probably averaged around 15% of portfolios. So it's got a very big investable property universe in the US, but it's been very well accepted by the multi-asset portfolios, as I say, up to 15% of their portfolios pretty much from time to time.
I mean, just to add on to that, and something that's, in maybe just at least looking at the market and trying to assess what people are thinking and saying, which is very little at the moment. There's one asset manager yesterday that came out saying that they are looking at property and adding 15% to that. Maybe as a panel, can you comment on whether you believe that's an appropriate allocation given where we find ourselves, both from a valuation perspective, but then also, at a fundamental perspective, for a traditional sort of, I would say, typical balanced portfolio. Greg, you want to comment on that? And I'm happy for you guys to chip in as you go along.
Well, I was going to address it later on one of your questions, Rafiq, but the disparity between the 10-year mean PE for general equities on the S&P versus the REITs, the gap is about 20%. It's really significant. And certainly it's showing good value. And also, if you're selective with your particular sectors, you can get good visibility of earnings growth in US dollars. So certainly I wouldn't be shy to go to 15%. Actually, my own personal retirement annuity, I've got 20% global property exposure, just to support that view.
Mine's 50.
No, you're not allowed to have more than 25%, Mark.
Kunda, you want to comment on that?
Yeah, happy to comment on that. And again, we always see ourselves at Strategic Capital as a building block. So the asset allocation decision, Rafiq, you know that mostly actually rests with the likes of you. But if I was to kind of take a stab at it and say, is 15% the number? I think it's probably close to the number. And you could maybe break that up between local and global property. However, my view is maybe a little bit more cautious, although we're seeing a lot of value in the sector. If we're looking at global property and local property, I think a measured approach to allocation is probably the right approach, because I think what a lot of the central bankers have definitely said is that we are in this higher for longer environment. So even if interest rates peak, hopefully this year, they're not going to cut, in Q1 2024. Probably the first sort of cut or view about cutting is a little bit later, that maybe 2 or 3 quarters after that. So I think in that period, you might see a little bit more wobbles in terms of market volatility, not just property, but global markets. And I think your entry points will be a few, meaning that if your goal over a 12-month period as an allocator is to get to, let's say, 15%, if that's the number, I would say that you can probably do a chunk now. You could probably do half of that, quite soon, because I think the big alpha opportunity is when, to your point, Rafiq, no one is talking about the sector. Everyone hates the sector. Usually that's where the big alpha opportunity is, as opposed to when everyone loves the sector. However, what will happen, I think, is that the global economy is yet to go through a few wobbles in terms of unemployment rising, in terms of some sort of dislocations that happen because of these rates that have been high for a very long time. And in that period, you might find a good entry point now when it's cheap. You might get another rally in a few months, and then you might get a bit of a correction after that, and you top up again, as opposed to kind of getting all of it at once, is what I would say. And any of our clients that are asking the same question, we are getting a lot of these questions. We're saying, go in, but don't necessarily jump in. Don't jump in the pool in one shot. You kind of can actually do it over the next couple of quarters in a very measured approach, because you're really looking at this from a kind of 7 to 8 year period, that it's okay to actually do it over the next few quarters as opposed to all in one go.
I got you. And I guess that's also informed by the fact that, the sector for the past decades been sort of highly under pressure as well. Yeah. Okay. I suppose, adding on to that, and Greg, in thinking about the economic landscape for South Africa more specifically, and you teed it up nicely in sort of your first comments. So, the challenges that we face are high interest rates, slowing global growth, risk of recession, either being hard or soft. I don't think this no landings scenario is one that's getting a higher probability. The question is, how have you catered for this in your portfolio, be it your and specifically, I guess, your global portfolio, and I guess the question is, from a South African point of view, what do you think the return prospects are, and indeed the risks associated with that return?
I think, look, you raised inadvertently the question of risk-adjusted returns, and like Hong Kong and the UK, the risk-adjusted returns, potential returns in South Africa relative to what we have out there in the greater universe of global property is not favorable at the moment. Also in a privileged position that we don't have to speculate and guess. I'm quite happy to miss a 2%, 3%, 4% rebound if something changes, to get a confirmation that something has changed in, for instance, those 2, 3 economic regions that I've mentioned, and possibly even Singapore. So it's just, in simple terms, South African listed property from our portfolio construction process is right at the edge of the radar screen, and we're not spending too much time speculating as to when this is going to turn, because we are concentrating on the sectors that are likely to continue to deliver growth, even in a slow economic growth environment, or even a negative GDP. And also we're focusing intensely on the quality of the balance sheets. And to that effect, we've got a substantial overweight to the US. Nothing in the SA at the moment, nothing in Hong Kong, very low in the UK, overweight in the US. we've just got so much choice there. And we can also avoid certain sectors in its entirety and yet still get as much diversification that is required to avoid too much volatility.
Thank you. Mike and Kundai, maybe after that, do you want to maybe comment on, what you think about at least what investors can think about from a return perspective in the near term?
I mean, maybe just, talking to what Greg was discussing. I mean, you got to look at your customers and what they need and what their needs and wants are. You have an investor group that wants South African exposure or JSE specific exposure. And one needs to look very carefully at the counters in that universe and plan accordingly for them. For whatever reason, they may have their beliefs in South African property, and one needs to structure for them. It may be more tax advantageous for South African investors to hold South African REITs. There's less leakage in terms of dividend taxes, withholding taxes. And one can structure a much higher yield portfolio right now for investors that specifically want SA portfolio. If one was totally agnostic, then maybe Greg's argument can apply. And if one was totally agnostic with regard to tax, sure, then you can start structuring a nice international portfolio, US dominant, but you're going to be hit with a lot of dividend withholding taxes. And you're starting off at you're going to have to accept much, much lower kind of div yields on your US portfolio right now. So as I say, horses for courses. We can't be too dogmatic in our approach.
Got you. Kundai, do you want to comment on that?
Yeah, I mean, from our side, when we're looking at total return outlooks, 12 months for SA, we're looking at a number of about 14%, and over the next couple of years after that, we're in the region of something in the region of 12 to 14% per annum. If we look at 3 to 5 years out. However, the makeup of that return when we're looking at global is different. In the global space, we're looking at about 12 to 13% in US dollars, and the number I quoted for South Africa is a rand total return expectation. But I think an important thing is to also think about the makeup of that return. So in South Africa, because of the relatively higher dividend yield expectation, we're expecting about 8.8 to 9% on the dividend part, and not distributable income. And I think it's important to note that the distributable income, which means that the income that companies can pay on a yield basis is about 11, but they're only distributing about 9 because they're holding back a little bit to shore up their balance sheet and kind of make sure they're well capitalized to keep their buildings, call it fit for purpose. So if you have 9 of the 14 odd, about 65% of your total return is income, which has a much lower forecast risk, which is the 12 or 36-month income number. In the global space, like I said, the number is about 12 to 13%, but about 4.5% of that is the dividend portion. And I think obviously that's about 33% of your total return of the income piece. And we are total return investors, but I think for investors, it's very important to try and ascertain what are your components of returns and what is the kind of forecast risk you're willing to accept. There are opportunities in both, and some of the points that Greg has mentioned, I absolutely agree. But also, maybe kind of leaning on Mike as well is, some of our investors just want the pure SA exposure, where they want they're seeing this 37% discount to NAV, and they're seeing it as very attractive. Global property is more kind of 15 to 17% discount to NAV. So it's very attractive, but it's not, let's say it's not as hated as South African property. And sometimes, like I said, the opportunity for alpha is in the one that's the most hated. As long as the fundamentals are fine, the balance sheets are okay, and we think that there's opportunity. So I think that's the way investors should kind of think about it.
Thank you. I want to ask one last question on the local side and then move on to global, because I'm almost going to hazard a guess and say that when we speak about global, things tend to get a little bit more exciting and people feel maybe a little bit more upbeat about it, just given Greg's little smile over there. But I mean, no conversation is ever completed from a South African context if we don't talk about load shedding. And we all know that it's a massive drag on the economy. And that, I guess, from where we stand, it's probably the second biggest impediment to economic growth in South Africa. And I guess from a property company perspective, they're probably a little bit more aligned to the fortunes of what happens in the economy more directly. Can you comment on how property companies have navigated this within the various sectors, being retail, office, and industrial, and talk about how that's impacting the revenue and their net margins and potentially just the health of the business. Kunda, if you want to start, and then I'm happy for Mike and Greg to comment as well.
Yeah, I was hoping we wouldn't talk about load shedding, but since we're here, I think you're right that the load shedding has had a pretty devastating impact on some parts of the economy. I think we've all seen some of the headlines that retailers like ShopRite or some of the other guys have said in terms of what they're spending just on pure backup, diesel, and all of that stuff. But what we've seen, certainly in the last 18 months, is that our listed property companies in South Africa have really been front-footed and have taken this really head-on in trying to make sure that they kit out the buildings with sufficient backup capacity. So, and what's kind of like the cherry on top is that they are able to do this at returns that are sometimes more attractive than actually buying physical property. So, to put some numbers to it, Redefine Resilient. Resilient is actually probably one of the better examples. Is they've committed 1.2 billion over the next few years on their solar or backup power rollout. And what that will do is that will actually enhance their returns, because the IRRs, internal rate of returns on that, are between 16 and 18%. And in the economy that we're in, sometimes actually quite difficult to get that sort of return out of some property types. So what the guys have done is they've almost reallocated some of their capital to these backup solutions. And Equitas Property Group started this quite a while back, where they built, their brand new warehouses with solar already in, and they would give this as a benefit to their tenants. And what that did is that it just lowered the ability for the tenant to leave. So the tenant was now saying, we get this kind of power or cheaper electricity and reliable electricity advantage, and we're definitely not going to leave these buildings. So we saw their vacancies compress and their tenant turnover actually go low, which is a good thing. So we found in most cases that our listed property sector has really been front-footed, and we'll see high prop. A lot of us would know the shopping centers like Canal Walk and Hyde Park and all of that stuff in the urban areas. We'll see a big rollout from high prop over the next 2 to 3 years. That yes, load shedding has a negative impact on consumer sentiment, the consumer, and in some cases on direct operations, is the cost of operating. But what the property companies have done is I would say, a remarkable job at actually keeping the lights on in their buildings, meaning that relative to some private players who may not have as much capital to play with, these guys are actually in a probably advantageous position. So we actually quite encouraged, and they're doing all of this at IRRs of 16 to 18%. So it may actually enhance the returns in the midterm.
Maybe if I can just counter on one of those points. I mean, obviously the landlords have been front-footed, and they've put in solar. It's not necessarily the best quality of earnings, because we don't know exactly what the return profile is going to be over the next 10 years on that solar or on that expenditure. But the reality is where they're using generators and they've had to bring in diesel costs. As much as the landlords have managed to pass on this cost to tenants. We've got to understand that this merely adds to the tenant's cost of occupation. And what happens when tenant's cost of occupation goes up, it leaves less in the pot for the landlord to squeeze out of the tenant in terms of basic rental growth. So base rentals are purely under pressure because of the extra diesel cost. And that is obviously not great for landlords. It's you eating into our pie. The fact that we need to provide diesel to tenants at a high cost eats into our growth pie.
I got you. There was one question that came up in the chat about, whether these listed property companies are giving some reprieve to the tenants, given the challenging environment that we talk about here. But from the conversation, it sounds like actually, these the rentals are actually likely to go up as a result of the intensified burden on listed property companies to cater for some of the challenges that the economy puts these property companies under.
No, rentals can only go up on a supply-demand curve. You can't just put up rents. If the tenant can't afford it, you won't pay it. And if the economy is shrinking and they can't afford higher rents, you're going to charge them lower rents, regardless of your diesel cost.
I got you. Let's move on to the global side. And obviously we don't have much time here, but I think, in thinking about the same question which we framed for SA listed property, I guess, can we make a case for global property under the same sort of guise of a weak economic environment, interest rates at peak levels, inflation still being relatively sticky upwards, and I guess from that perspective, is there a case to own global property in one's portfolio? Greg, do you want to give that a stab, since I guess you're the global property bear out there, not to say a bull, not to say that the rest of the panel isn't?
Rafiq, many an analyst has been humiliated by the 10-year and the US Fed funds rate over the last almost 2 years now. So I don't want to speculate too much, other than it looks as though it's peaked. What the interesting thing is that the US Fed funds rate is ahead of the US CPR, PPR rates. But they're sending out messages that they are still it's going to be higher for longer. At the same time, they better watch out for that economy. It can turn around very, very quickly. And that is why we have identified sectors, and more particularly holdings, that have got strong balance sheets, by implication, very low loan to values. Many of our viewers will probably be surprised to hear that in many cases, US REITs and Australian REITs in particular, the loan to values hovering around 30% average only. Of course, Europe is far higher than that, in the 40s on average. So, and then also we look at the quality of that debt, and many of the US REITs with growth as well, growing income, have got debt that expires in about 3 years' time, that was raised 5 years ago in the artificial environment of when rates were around 2%. So we can look forward to being selected and deliver real growth. And the particular sectors that we have got exposure to are data centers, healthcare is very robust. The baby boomers can afford to have hip replacements and go to retirement homes, and so there's still some runway there. US apartments, as much as you read in the New York apartment rents are coming down, but there isn't enough apartments, and there's no real stock coming online. Self-storage also does very well in this environment. And of course, logistics keeps eating away at bricks and mortar retail. one statistic I can put forward is in the global market capitalization, logistics has grown by 6%, and bricks and mortar retail has decreased in market cap by 4%, to give you some idea. And incidentally, we've got absolutely no exposure to office, traditional office. So I'm confident that we can deliver a real growth in US dollars and on those grounds and those particular sectors, including communication towers as well.
Perfect. I'll come back to Mike and Kundai on that question more from a attraction point of view at the back end of what we want to talk about in this global part of the conversation. But Greg, maybe you can describe the different sectors that constitute the global property universe. And is it fair to say that if one looks at South African property being sort of industrial, retail, and office, more broadly speaking, is this a much larger opportunity set given the different myriad of sectors that are out there?
Well, Rafiq, this slide that has been pulled up really describes it. There's now 28 sectors and subsectors, and I recall a good 20 years ago when I started looking at it, even internationally, there was about 4 or 5 sectors, was retail, office, hotels. Now there's 28 sectors and subsectors. I would have never thought, for instance, that logistics would be such a big player, but it really came to the fore during COVID. Then you got cold storage. I would have never dreamt that there would be cold storage REITs. So this gives you some indication of what our universe is. And as I said, it is so large now that you can actually avoid sectors completely or even regions and yet still get diversification. And I've identified those particular sectors where we believe they will deliver growth in real growth in real terms in US dollars over the next 2 to 3 years. And of course, looking at the quality of the balance sheet. The other thing as well is that you get a pretty large dispersion between the top performers and the lower performers when you go into the global property universe. For instance, in residential, there's particularly in US residential apartments, there's almost 28% dispersion between the top performer and the lowest performer, which is great for stock picking and inclusion in your portfolio. So this is the universe, and I wouldn't be surprised if there'll be more being added that you wouldn't even think of, so long as it's tangible, immovable, and it generates revenue by rental contract, and it's blessed by the authorities as a REIT, then it is a REIT. And
Mike, maybe you want to add to what Greg said, or is that as
well? I mean, I could just make a comment. I mean, having chatting to some tech guys recently about artificial intelligence, the AI boom, it's crazy how it's caused panic demand for cloud computing power just over the last few months, and that has meant that your data center REITs are clamoring around for new sites. They've got huge pricing power in terms of rental pricing power, and they are showing massive. They are going to show some massive growth going forward, and I suppose it's priced into their pricing to a certain extent. But it's an element, it's a sector that will be larger than office, in terms of value. It's and then the amazing story is like something like American Tower, which is a massive REIT that owns all these cell phone towers, or has leases on pieces of land where they put up their cell phone towers, is one of the biggest REITs in the world, well over $100 billion valuation. Yeah, so these obtuse property types are dominating.
We are overweight towers and data centers for those very reasons, Mark.
I want to get into some fund specific stuff because I think that's also what some of the attendees are here for. And I was looking at some of the performance, and Mike, the one that stood out from a global fund perspective was yours, largely because if you look at the performance of the fund over the last 3 years, I think it's done something like 11% in dollar terms. And if you look at that relative to the sector, the sector's done less than 1. And so maybe you want to talk to how that level of outperformance has kind of been delivered. I see in the face of a very, very challenging environment. The one thing I want to point out, though, to the audience is that, your fund 65 million, whereas the rest of some of your peers are north of 500 and in some instances R1 billion. And so maybe the obvious question there is, from a manager research perspective, is would it be replicable, that same performance, had you gotten R1 billion from an investor?
Yeah, a fair question. The global universe is huge of REITs. I mean, there are nearly 2,000 REITs listed around the world, worth about $2 trillion or 40,000 billion rand. So give me a billion rand, $50 million, and BCI can invest it for you in a day. We'll merely overlay our our finely tuned model portfolio, and we can populate it quite quickly. I think the smallest cap stock in our fund is about 20 billion rand. So if we took a 5% exposure of R1 billion, we'd only have to invest $3 million. So I'd say we'd be in and out, or in and out in an hour. So the answer is yes, yeah, certainly we could, because this universe is huge on a global perspective. Maybe once it gets to 10, 20 billion rand, it gets a bit more trickier. But I think also when you're not necessarily when you're not necessarily an index hugger, when you are a best ideas fund, and obviously looking at a macro view, but you're also doing a bottom-up research, there's possibilities over time to obviously produce alpha, and whether we can continue with it's another story, but we will continue to try. That's all we can do.
Thanks very much for that, Mike. I'm loath to ask another question because I think we're 1 minute over. But I guess for me, the parting question is for the audience, maybe very quickly in 15 to 20 seconds from you all, looking at the valuations for global listed property, and looking at an index having a sort of a price to book of 1.2 times and a dividend yield of 5%, which is very similar to the current dividend yield that the current yield that you can get on a shorter dated US Treasury. Is the opportunity still sort of ever present from an at least from an asset class perspective? And I guess the question is, what are we as investors missing when it comes to global property as an asset class? Kunda, do you want to start?
Yes, Rafiq. I think before I start, and I know I'm eating into my 15 seconds, I think the measure that you've looked at, us as property specialists often don't look at, or investors should be aware. You mentioned the price to book at 1.2. And I think an important thing to note about the US, which is 67% of the index, those companies don't report their market values or their NAVs, meaning that they report their book values at historic cost. So if someone bought a property 30 years ago at $200 million and it's now worth $2 billion, the book value at 200, the book value will reflect that 200. So I think investors should just be aware of that. If you actually look at global property on a price to NAV, and the V in the NAV is market value, that is trading at about 0.8 times or 0.83 times to be a bit more specific, implying a 17% discount to NAV. And on a forward yield, dividend yield basis, as I said, the number is about 4.5%. And we're expecting about 5% FFO, funds from operations, or simply put earnings growth over the next 1 to 2 years. putting those things together, we think it is screening attractive. And if you look to Greg's point that he raised earlier, relative to equities, which obviously have had a better outperformance track in the short term, global property screens really well relative to equities and probably fair to cheap relative to NAV. Again, what I said is the total return expectation is a teen number, kind of like 12 to 13%. But just know that because the makeup of your return is only 33% dividends, a lot of your return is going to depend on the re-rating of the sector, which a lot of the time is driven by the bond yield expectation. So domestically, you might get the similar return, but it's less dependent on bond yield movements, actually more dependent on income. And in the global space, it's more dependent on the bond yield movement. So there may be a little bit more volatility on that journey to 12 to 13%. Overall, we think both are attractive, but I think South Africa is showing deep value.
Thank you. Mike?
I think Kundai chose all the good answers there, but I'm going to say I'll just focus on one, which is inflation. And property has proven to be a great inflation hedge over the medium to long term. As I said, if cost of buildings go up, eventually landlords will need to get a certain amount of return on that new cost, and they're going to get it through increasing rentals. So as long as the economies can support it, rentals will grow over the medium to longer term, and will drag property dividends distributions along with it. So as opposed to your bonds, which have no inflation hedge, property is an inflation hedge over the medium to long term, and I think it's showing great opportunity at these kind of levels.
Greg, you want to chip in there?
Just building up on what Kundai and Mark put forward, the global property sector or asset class is showing good value. I'd even use the word extraordinary value if you start excluding things like office and focus on those growth sectors that we mentioned in the discussion. And this is the ideal time to start entering global property into your portfolios.
Gentlemen, thank you so much for the discussion, and Eugene for allowing us to go at least a couple of minutes over. It's been a great debate and conversation, and hopefully one that picks up a little bit more airtime in the near term, because it's definitely an area that shows a lot of value. So from my side, thank you so much for the engagement. Appreciate it.
Thank you, Rafiq. Thank you.
Yes, thank you.
Thank you. Bye-bye.
Eugene, over to you.
Yeah, Rafiq, thank you so much for making for a really interesting conversation. Like I said in my introduction, these are the true experts when it comes to property. Richbay, Vigio, Sesfikile, Greg, Mike, Kundai, thank you so much for your time this morning. It's been very insightful indeed. Definitely not an asset class that can be ignored, showing really good valuations. If you want to get hold of any of the managers, you know how we work, open door policy, let the BCI team know, and we'll get you in touch with either one of them. Rafiq from the BCI side, again, thank you for moderating a session. You've done a fantastic job. Quick reminder, next week, Wednesday, 11 October, we're back again, boutiques on Wednesdays, joined by Vunani Fund Managers, where we'll keep you informed and updated on what's happening on markets and valuations. Thank you all for participating and your continued support. We are grateful, and we'll chat to you again next week, Wednesday.